to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. We are coming to you live from Miami at Exchange in ETF Experience, where we're meeting with the top thought leaders and innovators in the ETF space. Joining us for this segment, we have Phil Mackintosh, Chief Economist at Nasdaq. It is great to see you somewhere else besides New York and somewhere else besides Zoom, but certainly in Miami.
And it's much warmer than New York.
It is, yes, it is definitely a much nicer place to be. And it's so interesting what we're seeing in the ETF space, whether we're thinking of thematics and retail investors and what's happening there, of course, market structure, which is your wheelhouse. And retail has been buying ETFs more than they do single stock trades. They buy to own ETFs and trade stocks. What themes do they appear to be drawn to?
Yeah, it's really interesting. So we've been spending some time looking at what the retail flows have been doing since COVID, because retail became a much bigger part of the stock market once we saw the stimmy checks going out. And actually what you see is a lot of net investment, so net buying of ETFs. And then the stocks trade a lot, but there's not so much buying in the stocks. And so when you look at what the ETFs are that people are buying, it was really interesting. At the start of COVID, we saw a lot of online retail, we saw a lot of energy, which had sold off. So you see some pretty thematic bets being put on, rather than just buying the total stock market or a bond ETF. There's enough ETFs in the universe now. You can do some pretty active portfolio construction with the ETFs. You can target a specific theme or sector or segment of the market and buy an ETF that expresses that view.
And your team spends a lot of time looking at liquidity. How does ETF liquidity compare to stock liquidity?
Yeah, there's a long answer to that question, because an ETF is a stock, but it's also a portfolio. And so the ETF complex trades lately about $200 billion a day, which is a lot, but actually stocks have been trading $500 billion a day, so they're liquid as a whole, but not all ETFs and not all stocks trade every single day. And so there's a complex of ETFs that are less liquid as securities. What's important to remember though, because they're a portfolio of stocks, the underlying stocks are still trading, and so if you really need to do a trade in those ETFs that aren't trading all the time, you can get a market maker who can do arbitrage with the underlying stocks and create liquidity, is what they say. But you can do billion-dollar trades in a large cap ETF, even if it hasn't traded for 3 days.
And that's my next question. Is there any impact to ARB opportunities now that we start to see spreads continue to tighten with ETFs?
Yeah, so one of the things people probably don't realize is that ETF spreads, so the difference between the bid and the offer, is actually usually tighter than the bid and the offer of the underlying stocks in the basket. And so often the ETF will trade up and down without necessarily getting to a level where the stocks are worth arbitraging. And so we see, of the $200 billion worth of ETF, we think about 10% of that flows through into stocks in the form of arbitrage and then flows back. So not all the ETF trading causes stock trading, is the short.
Is that true with thinly traded ETFs?
Well, thinly traded ETFs actually quote a lot tighter than people think. They just don't trade. So They're definitely not causing stock trading because they're not trading at all. What's interesting is with spreads as tight as most of the thinly traded ETFs have, that you see a lot of cancel replaces and message traffic. The quotes move, the quotes move, the quotes move, because the market makers know exactly where the fair value of the ETF should be, and they keep it at that price, so much so that somebody that's looking to arbitrage the ETF often doesn't get an opportunity.
Any other research from your team that stands out?
Yeah, so I mean, you talked about the fact that we focus on trying to make trading better, and we've been spending a lot of time looking at some things called guardrails. So there are some processes in the market that try and stop bad trades from printing. One of them is called limit up, limit down, and so it works as a high price and a low price guardrail for stocks. And the way that ETFs work is the thinly traded ETFs, the ones that don't trade very often that you talked about, are put in what's called tier 2, where those guardrails are twice as wide. But if you look at those ETFs, they're all the same underlying and underlying volatility as the tier 1 ETFs. And so we've been trying to work out if you could put the tier 2 ETFs into tier 1, give them tighter guardrails, which will protect investors more, because they'll be I guess, halted and reset before they get to too wide a dispersion from the previous price.
All right, Phil, appreciate the insight as always. Thanks for joining us on Trade Talks, and thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.